Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is October 2020. This is obviously the year when governments and central banks have been reacting to the coronavirus epidemic. And many concerns persist that the risk is deflation and that central banks cannot do anything more to stimulate economies and boost prices. I'm going to spend most of this presentation talking about that, and I want to point out two distinct kinds of problem, if you like, sort of pathologies of monetary policy in a capitalist economy. The first one is this idea that when the interest rate, the central bank interest rate, has dropped to zero, there's virtually nothing more that the central bank can do. There is this proposal for negative interest rates currently going around in Britain, but I'll just talk about that in a second. But no central bank has pushed interest rates beneath -0.5% or so. So there is this effective lower bound at around about zero. Then there is this quite separate problem. They sometimes get confused. They're quite separate. This idea of the so-called liquidity trap that goes back to Keynes's 1936 classic on the so-called general theory of employment, interest and money. Now let's just have a look at we've got the interest rates come down to practically zero. Why not make interest rates negative? They are negative at the moment in the Eurozone and Japan. Why shouldn't we do that in Britain as well? Well, in practice, what this really means is that the central bank charges an interest rate, perhaps 0.5%, a very low figure, on the cash reserves that banks maintain with it. So usually banks keep some cash reserves with the central bank. The cash reserves can be converted into notes. The notes can then be used to repay depositors. And the cash reserves are also used for settlement between the banks. Now, let's just be clear about this. This is actually a payment that banks have got to make to the central bank, to the state. It's effectively a fine on the banking industry. That obviously reduces the bank's profits. And over and above that, if the central bank rate goes negative, it's very likely that the yields on very safe paper, government securities, treasury bills, this kind of thing, will also drop to very low levels, may even go negative as well. Now, usually commercial banks have got some deposits on which they pay no interest, and some assets on which they do receive interest, including these government securities, treasury bills yielding 2, 3, 4, 5%, sometimes even more when there's rapid inflation. And the effect of dropping interest rates on these assets to very low levels or negative levels is again a hit to banks' profits. So one of the most important effects of negative interest rates is actually to punish the banks. It's to make them, to reduce their profits and to reduce therefore their ability to retain capital, the capital they need to support future lending. It isn't at all clear to me that it's a good idea to do that, and it's not at all clear from the behaviour of Japan and the Eurozone in the last few years that it's been much help. But in any case, the central bank can always increase the amount of money by very simple operations. The central bank or the government can always go to the commercial banks, borrow something. In case of central banks, they add to the commercial bank's cash reserves. The central bank then uses the money from this operation to go and buy anything from the non-bank private sector, and that boosts the quantity of money, and that, we can be pretty confident, does boost national income and expenditure in the medium term. At the Institute, we track the behaviour of money and national income over periods of 10, 20, 30 years in the main economies, and there's a very clear relationship. There is never any need for a central bank to impose negative interest rates. It's in practice, as I said, a fine on the banking system. Never any need to do that because the central bank can always increase the quantity of money, and that boosts national income. Now, the claim I've just made is a little bit controversial in that, let's get on to this second pathology, the liquidity trap put forward by Keynes in 1936. What Keynes put forward here was the following idea. You've got an investor who can have money or bonds. Obviously, the bonds pay a fixed rate of interest. Normally, if there's a sudden increase in the quantity of money, investors won't want all of that money, and they'll put some of it into the bond market. That'll push up bond prices, push down the rate of interest, and stimulate the economy. But think about a possible case. Suppose that the rate of interest in the sense of the bond yield really, is already very low. Then it's possible that investors will expect the next big move in yields to be upwards, which will give a capital loss on a fixed rate bond. Therefore, when the central bank carries out these operations and increases the quantity of money, there's no downward effect there's no boost to bond prices, there's no downward effect on bond yields, and in that sense, monetary policy is exhausted. There's nothing further the central bank can do. Now, this liquidity trap has been in textbooks for decades. There's been hundreds of academic articles written about it. I'm sorry, it's a very silly idea. Look, most investors have a choice between money and bonds and equities and houses and works of art and all sorts of things. It isn't the case that they're confined simply to this choice between money and bonds. Let's think about, for example, the balance sheet of the American household sector at the end of last year. In America, the bond market is larger than in Europe, relative to the economy as a whole. In Europe, the banking sector is more important than the United States in relative terms. So I haven't biased the answer by choosing the United States to illustrate the point I'm about to give you. At the end of last year, the value of bonds directly held by American households was 4% of their gross wealth. That's wealth before we've deducted the debts that households owed. 4%. 96% was in other assets. So why was Keynes so obsessed about this choice between money and bonds? In practice, when the central bank carries out operations to boost the quantity of money, that changes the equilibrium level, the right level, of all asset prices, the equity market, house prices, everything. As soon as you start thinking these terms, we can see that the liquidity trap is a very silly idea. The Institute of International Monetary Research is holding a webinar conference on the 28th of October, where I'm going to be giving a paper on what I call the money equities interaction channel. That is the effect of changes in the quantity of money on the level of equity markets. It's a topic I've dealt with in previous videos from the Institute. I've indeed been talking about this sort of thing for the last 20 or 30 years. As soon as you start thinking these terms, the liquidity trap just disintegrates as a silly idea, as something that's really no practical, real-world significance. But the relationship between money and equity markets is important, as I'm going to show you in the next few minutes. Equities and real estate, mostly houses, are together about half of American household wealth. Americans also have got equities through pension funds and insurance companies, but pension funds and insurance companies also hold bonds. Roughly speaking, getting up a half of US household wealth is in assets that don't have a fixed rate of interest. all right, that have a rate of return that increases over time as dividends increase, as rents increase, and so on. What I found in my work is that large financial institutions, long-term savings institutions, pension funds, insurance companies, unit trust groups, mutual funds, and so on, what they tend to do is to keep ratios of cash, of money, to total assets relatively stable over the long run, rather as households keep stable ratios of money to income and wealth. I give an example from my own career in the City of London, where I looked at about 30 years of data from 1973 to 2003. I put together the ratio of liquid assets to total assets held by large UK financial institutions. The money held and the assets owned by these institutions rose about 50 times in that 30-year period. But the ratio of money to assets was much the same at the end as at the beginning. There had been periods when the liquidity ratio was much higher, periods when it was lower, but over the whole 30-year period, wasn't much change. I've recently just put together some numbers for the American mutual fund industry, looking at the 20 years up to 2019, looking at the ratio of money to total assets for these institutions, predominantly equity investors. Again, the ratio of money to assets, more or less the same at the end as at the beginning. And in that 20-year period, the assets and money holdings of American mutual funds have gone up about 3.5 times. The other thing I've noticed in economies is that when the quantity of money changes, that's for the whole economy, the money balances in the financial sector change by much more. When the quantity of money goes up by 10%, money held by the financial sector goes up by 20-30%. When the quantity of money is stable or falls slightly, the fall in money held by the financial sector is much larger than that. What does that mean for the equity market? There's this stability of money holding behavior, but the quantity of money held by this institution goes up and down a lot. What does that mean for the equity market? It means that the fluctuations in equity prices are going to be larger than the fluctuations in national income and expenditure. That's obviously a very, very important conclusion to draw about the power of monetary policy in a modern economy. The effect of these large movements in equity markets is to people spend more when the equity market's gone up. They spend less when they've just had a hit to their equity portfolios. There are further consequences. When there are high share prices, companies typically issue more paper. They put up some more equity. That takes money away from the financial sector. That then goes into company balance sheets. Companies are more liquid. They can invest more. Let me close by just giving you 2 examples of all this. One was in the spring of 2009 in Britain. In March 2009, the Bank of England started quantitative easing. It had created the purchase facility to buy long-dated gilts. It had done that a few weeks earlier, but it started operations in March 2009. The equity market had fallen very heavily in the previous 3 months and was at a low point. Between early March 2009 and the end of 2009, the UK equity market rose by 50%. It was also a period when there was a dramatic improvement in the prospects of British companies with the confidence index in the survey carried out by the Confederation of British Industry rising faster than any other time in the history of that survey. So you had a very clear demonstration of the power of monetary policy to change the quantity of money, to impact on equity prices, and then to affect the economy. We've seen something very similar this year. Again, it happened in March this year. It was the Federal Reserve. the Federal Reserve announced one Sunday that it's going to carry out enormous purchases of government bonds in the following week. Equity market dipped a bit the day or two after that, and then it started to rise, and then it again rose by, I think it's 30–40% in a matter of months. We have here a very clear illustration of the power of monetary policy to change asset prices and then to affect economies. Keynes's liquidity trap idea was very artificial. It was about an investor confined to a choice between money and bonds. As soon as you get into the real world, where most investors are thinking about money, equities, convertibles, venture capital, hedge funds, I'm sorry, the liquidity trap is just nonsense. It's just a very silly idea. Central banks can never run out of ammo. They can always boost an economy by increasing the quantity of money. We finish by saying that in my last presentation, I talked about the kind of weird situation in which in America there are some economists who wonder whether the Federal Reserve can increase the rate of consumer inflation from 1.25% to 2%. And yet at the same time, just go to Latin America and you see Argentina with an inflation rate of 40% and Venezuela with one of over 2,000%. It's all to be explained by the behavior of the quantity of money. Thank you.